this is Tavi Costa here with Crescat Capital. We're in the Precious Metal Summit in Beaver Creek, and I got Ronald Stöferle here with me.
Hi, Tavi.
Yeah, good to see you. Let's have a macro talk, but we're going to be recorded.
Can you spell my last name again?
No, I cannot do that. That's way too hard. Say it again. You got to say because it's
Stöferle.
There we go. It's a Brazilian accent, doesn't go very well there, but I would love to ask you a few questions. Let's start with kind of higher level. Now, something that's in my mind. Let me ask you a quick question. What do you think, NASDAQ down already, call it 25, 30%, and the Fed's reaction, not to that, but the reaction to inflation has been raising rates by probably 75 basis points in the next month, shrinking balance sheet by another 95 billion. You look at global central bank assets are actually declining by about $3.5 trillion. Where are we going from here? I mean, it seems to me like they're not shifting and injecting liquidity like we saw in prior times. So where do we go from here in your view?
Well,
I know, it's a tough question, man.
No, it's. I mean, there's so much going on, actually. And, I'm from Europe and being here in the US, it feels like a little bit of a relief because in Europe, it's really the whole atmosphere is very, very tense, very nervous. People are getting angry and, they're just concerned regarding the winter and the electricity bills that they're facing, and inflation is much more sticky over there. So I think if we have a look at the big picture, what's really interesting for us as asset managers is this interplay between massive asset price deflation and very sticky consumer price inflation.
Yeah.
And in financial markets, until the end of August, equity and bond markets were down, I think, 54 trillion. Mm-hmm. So that's more than the combined GDP of China and the US. It's a huge number.
Yeah.
And this is like the reverse wealth effect that the Federal Reserve wants to create to achieve a soft landing.
Yeah.
Now, in theory, it sounds great. But what I can tell you, there's no risk appetite. From my point of view, a recession, and not just a small technical recession, but really a nasty recession is our base case.
Yeah.
For Europe, China is not doing very well, obviously, and I think the US is also facing a recession. And then, of course, the big question is, additionally, we shouldn't forget, it's quantitative tightening now picking up momentum, 95 billion per month. Then we're seeing a very aggressive interest rate policy.
Yeah.
Last year, when we were sitting here, interest rates were at 0. Now we are heading to 4% at the end of the year. That's a huge move. And then we're seeing the US dollar acting like a wrecking ball, especially for emerging markets, but also for the Eurozone. So this is a pretty tough environment that we're in. And I think everybody's just waiting for this Fed pivot. When will they make the U-turn? From my point of view, at those inflation levels, it's not going to be the central banks that will move the needle. Yeah, it will be fiscal stimulus. So I think that's kind of the message that we're communicating. We should listen less to central bankers and listen more to politicians. Yeah, fiscal policy is going to be much more important going forward than central bank policy.
What's something that's been in my mind, though, is the fact that, if you have the level of monetary conditions tightening right now in developed economies, you would think, let's just use Brazil as an example. The Brazilian real should be it's trading now at, call it 5.5 handle. It should be trading at a 9 or 8. It should be completely collapsing, but it's not. Is it because it's going to collapse, in your opinion? Or is it because we're seeing things are way too undervalued? That's kind of my view, in a commodity-led economy market.
That's an interesting thought, and I think the dollar can be strong and weak. I think it can be strong against the euro, other G7 countries, against the Chinese renminbi especially, but it can be weak against commodities and also commodity producers. I think this is something that is building now. And what I just see, the credit risk that is emerging from some emerging market countries.
Yeah.
Have a look at CDS for Egypt, yeah, for Lebanon, for Turkey, obviously.
Yeah.
So from my point of view, it's pretty obvious that this strength in the US dollar, and I think it's going to continue, will cause a big crisis in emerging markets, probably the biggest in the last couple of decades. Brazil is doing pretty well, I would say. There are some other countries that also, I would say, really did a good job over the last couple of years doing reforms. They're profiting from the energy boom. I mean, I just bought Petrobras. I mean,
we own it too.
It's a fantastic company. It's priced ridiculously, yeah. And so I think that's going to continue. But from a macro point of view, the current setup, I think it's absolutely fascinating.
Yeah.
I think most people don't realize actually what's going on and how intertwined markets are. And I think with the gold market, we should be probably, that's the last market that I'm concerned of at the moment. Yeah, I think gold is doing okay. I mean,
it's doing fine.
For us in the Eurozone, in Euro terms, gold is up, 8%.
That's right.
Yeah.
Yeah.
For Japanese investors, up 15%.
Yeah.
So it's okay.
In the US, I was just looking at that. I think the 1 year chart showing a 6% decline. I mean, it's not the end of the world. I mean, you look at correlations like gold and treasuries collapsing, global bonds collapsing. They usually trend very closely. I think that breaking correlation has to do with the change in the macro regime. I think we're entering an inflationary environment. Do you agree with that? I think you agree with that, but anyways.
Yeah, last year the keynote that I gave here was called the monetary tipping point.
Yeah.
And I said that actually COVID was the tipping point for this inflation pendulum.
Yeah.
So we are actually now moving, we had 40 years of disinflation. And actually, I think in the Western world, no professional investor, no fund manager, no private banker knows how to navigate in an inflationary environment. It's completely new. And I think COVID was really the tipping point. Why? Because this was the move from monetary dominance to fiscal dominance. And we saw, I think it was 24% of GDP fiscal stimulus in the US. And it wasn't like tax credits or lowering taxes like in 2008. They were going direct. And obviously, compared to, for example, quantitative easing, which is an asset swap, if you go direct, and if I send you a check, $1,000 US, I think psychologically, it's like you win that money in the casino. It's you treat that money differently.
Yeah.
You're okay to just waste it, yeah. If you work really hard for that money, that's different.
Yeah.
So I think this move of going direct and more fiscal stimulus this is something that's going to continue. Now in Europe, they're subsidizing energy bills for all households.
Yeah.
It's going to cost ridiculous amounts of money. The consequence is that on the demand side, people won't really care about saving energy. And we could easily save 10-15% energy in households, for example. But I think that politicians, they enjoy this power that they have, and they won't give it away. So I think inflation is going to be stickier than most people accept. I still think that we have seen the peaks for this inflationary wave, but we're expecting, like in the 1970s, 2 or 3 inflation waves. And I think as soon as inflation numbers come down significantly, this will be the point in time when Jay Powell will say, well, I'm the new Paul Volcker, I killed inflation. Now we can, hit the pause button. But then I think that inflation will come back again, because there's so many structural forces driving inflation.
Yeah, and I wonder what policy making is going to be if we have, let's say, unemployment rates beginning to rise. Because in the 70s, we had those waves of inflation, right? 3 waves of inflation. That actually, after each of those waves, an average 2 years after the beginning of the acceleration of the CPI rate year over year, you start seeing 2 years after that, you start seeing unemployment rates beginning to rise. So we're about 2 years into this acceleration of CPI, which makes me think we're very close to the beginning of the upward move in unemployment rate. And that maybe was the bottom, you know, a month ago or so, or 2 months ago. And so, you know, just think about hypothetically, you know, markets are down 40%, let's say 6 months from now, unemployment rates are now at 7.58%. I mean, where would policy be? I mean, I think gold is going to start sniffing that, right? I mean, it can't be just as bad as it has been, I believe. I don't know. What do you think?
Well, actually, I mean, if Jay Powell wants to achieve his goals, he has to actually get unemployment up, and he has to crush the housing market.
Yeah.
And I mean, he's not going to communicate that, yeah. But you know, the Jackson Hole speech was quite. I think it was quite open. Markets didn't really like that. But what I thought was even more interesting was the vice chair, Brennert. She didn't make a speech, I think, since April. And I think last week she did another speech. And this was kind of dovish. And then there was the head of the New York Fed, which is obviously very, very influential, Williams. He also came out with a speech where I thought, well, I think at 4%, this is it.
Yeah.
So I mean, let's face it, Tavi. I think the fact that the markets believe this narrative, that they're now hawkish, I mean, it's ridiculous.
It is.
They don't know anything about the history of the Federal Reserve. Yeah. So they are doves in hawk's cloth, and I think at some point, and this is going to be a process, at some point they will have to reverse. I'm 100% sure about that. But it's not going to be the same U-turn like in 2018 when Powell reversed basically in 6 weeks. Yeah, it's going to be slower, and I think I'm totally with you. I think that gold will sniff that out. I cannot say if gold already made its bottom. It can go to the 1500s. Yeah. Worst case from my point of view, but still we should not forget, you know, what's going on in capital markets this year, with the equity markets being very, very weak. Bond markets, I mean, that's the biggest drawdown. Jim Bianco put that out, I think, since 700 something. Yeah. I mean, it's a disaster. Every balanced portfolio got completely wiped out. Yeah. Commodities didn't really work as an inflation hedge. Gold didn't really work as an inflation hedge. On a relative basis, it worked really well. Tips were a disaster. Every inflation-protected bond is showing really weak price action. So actually, I think, you know, now that the sentiment on gold is already that negative and the commitment of traders report has improved significantly, I think the worst is over. Fingers crossed.
Oh boy, keep saying it. Silver had its worst year in 30 years. You asked me, I never thought we would see something like that. I thought maybe a decline, but nothing to the degree like we saw. I think it has to do with the change in policy, and the, you know, markets went from there's no way they're going to raise rates to now, you know, believing somewhat. And to your point, I agree. You know, it's not really hawkish, is hawkish, but put in context, it's nothing compared to the 70s. What, in your view, this is my last question, by the way. What, in your view, is the best economic analog for today's environment, if there is any?
I think the 1970s.
Yeah.
So I mean, it was no coincidence that our report was called Stagflation 2.0. But we crunched the numbers, and we actually there's no quantitative definition of stagflation. Yeah. So we came up with our proprietary definition, and then we actually crunched the numbers and analyzed what works in stagflation and what not. And you know, there's many similarities. I think, you know, the root cause for the mess that we're in, you know, that started already after the GFC. I mean, we had like 7 or 8 years of zero interest rates. Like in the 1960s, yeah. I mean, this is when the whole stagflation, the root cause for the stagflation of the 1970s should be found. So we analyzed the similarities, but also the differences, and I think the main difference is obviously the debt level, which is at the moment 3 times higher, like in the 1970s, on a corporate level, on a private level, and on a government level. So actually, you know, we've got the most interest rate sensitive environment ever. even compared to 2000.
Yeah.
Debt levels are 3 times higher. So I think, you know, that's fairly easy. You don't have to have a PhD. Probably it's negative if you want to make that common sense call. But the higher the debt levels, the higher the sensitivity to rising interest rates.
Yeah.
And as we're seeing very, very rapidly rising interest rates, that's just not something that's you know, it's causing already so many troubles that will only come to the surface, you know, with the time lag.
Yeah.
We're seeing it in private equity. I just talked to a guy, for example. He's selling like very, very expensive Italian sports cars, like Lamborghinis and Ferraris. He says, well, actually, you know, for him it's fantastic to import those cars because, you know, the euro is so weak.
Yeah.
But on the other hand, nobody wants to buy them because his rich clients. I say, well, you know, having a look at my brokerage account, I'm not that rich anymore.
Yeah.
So this reverse wealth effect, it kind of works, but not, I think, in practice like this theory of those economists would suggest. So actually, I think it's gonna be a pretty interesting fall and winter season, and for us as asset managers, I think it's exciting. There's lots of fantastic opportunities out there, but I think, and this is my last point. Sorry for the long answers. I think, you know, one of the main trends in asset management over the last couple of years was passive investment. Mm-hmm. So everybody said, well, I just need an ETF. Yeah, screw you, expensive active asset managers. I think this is going to change.
Yeah.
I think the markets will stay quite volatile over the next couple of quarters. I think as a great asset manager, as an active asset manager, trading the bear market rallies, with the opportunity to go short, I think you will have a fantastic setup. But it's not the time for passive investments.
Almost like the opposite of what we had in the last 10 years, 20 years, 30 years. It's gonna
but perhaps I'm just talking my book.
Hey, you're talking my book too. So appreciate that. Yeah. Anyways, Ronnie, thank you so much for being here, for talking to me. I hope you have a great conference.
Absolutely.
I'll be watching your conversation with John Hathaway as well. Thanks for being here with Crescat, and we'll be back with other videos. Thank you.
Thanks.